I'm Scarlet Fu. Welcome to Bloomberg's Front Row. Today, I'm talking to Jim Chanos, one of Wall Street's best-known stock pickers on the short side. His firm, Kynikos, is celebrating its 35th year in business. Chanos made his name sniffing out questionable corporate practices and identifying fraud, including Enron's accounting maneuvers back in 2000. He now says central bank support, along with retail speculation, is creating excesses, underpinning what he calls a golden age of fraud.
And the longer a bull market goes, the more people's sense of disbelief erodes, and they begin to believe things that are too good to be true. And I think we're seeing that now more than we've probably ever seen before, in terms of the willingness of markets to buy outright frauds, or where there's evidence of fraud, or even where the evidence of fraud is sort of laid out for you.
We talked about the challenges of being a short seller in the current market environment, his painful short position in Tesla, why IBM is his highest conviction short, and the case against commercial real estate. Here's my conversation with Jim Chanos. Jim, I know you've admitted in the past that your shorts perform better when markets are rocky. 2020 has been nothing short of a ride. What has business been like this year for you?
We basically have assumed, like a lot of investors, that 2020 is a write-off, right? I mean, we're not valuing companies based on 2020 numbers. And I think the market increasingly is looking even beyond 2021 into 2022 as a more normalized environment. And we would agree with that.
So do you think it's harder or easier to find good shorts in this kind of environment?
It's easier to find them. They're just not working, Scarlett. There's all kinds of companies that are just sort of mind-numbingly not only expensive, but with seemingly large problems, and the market just, for the most part, just doesn't care. In fact, those companies often in 2020 are doing the best.
Yeah, I mean, when you look at what's going on out there, this current downturn is really atypical. The tide went out, and normally you have all kinds of companies left naked, but the Fed came to the rescue, as it has done many times in the past. Has the Federal Reserve made shorting a less appealing, even costly way of creating alpha?
A zero interest rate environment is a lot worse for short sellers than a 5 or 6% interest rate environment, all things being equal. But of course, more importantly, is the psychology. I mean, we're back to the environment where investors feel they have very little or no downside because they feel that they have a Fed put. And that's a dangerous, dangerous environment. We've seen that before, by the way. I mean, both the '07 market top and the 2000 market top, people forget, were marked by a belief in the Greenspan and Bernanke put. And now it's the Powell put, that the Fed won't let me lose money. And again, that's a very dangerous sort of place to be, because you're completely counting on the government to always make you whole.
So in that kind of environment, I know that you've talked about your short portfolio intended to serve as an insurance policy for clients who want to hedge their own long positions. What kind of appetite is there among institutional investors for some kind of insurance policy when they know that the Federal Reserve is right there to pick things up?
Well, that's it. They're looking at the Fed as their insurance policy, not the marketplace. And so people are quite interested in fundamental shorts because they see what we see. But then they sort of shrug their shoulders and say, yeah, but I don't really need it because the government's got my back. And interest rates will never, ever go up again in my lifetime. And if the market ever goes down, the government will rush in to save it.
So going back to what you're saying about how a lot of clients just don't think that they need the insurance policy right now, how do you respond to them?
Well, again, I mean, there's always uncertainty in markets, and the idea at some point that a Fed put doesn't get priced in would seem to be a little bit at cross purposes with the whole idea of efficient markets. I mean, the idea of efficient markets is that what we know is priced in. And right now, everyone knows that the Fed will never let them lose money. And as I said, that may continue, but that's a very dangerous assumption for market participants to have. Because if anything changes that viewpoint, Scarlett, everybody's going to rush from one side of the boat to the other.
Yeah. How much harder is it then to get these institutional investors to commit a significant amount of capital in the last 4 years then?
Well, as I say, it's been difficult for every short seller, including us. in that no one thinks they need insurance till their house catches on fire. And generally speaking, the fundamental short side over our 35 years, which you mentioned, has been able to generate returns even in anything but really rapidly rising markets. And so this is in a unique environment since Christmas of 2018, in that we've seen not only the central bank easing, but we've seen a return of retail speculation.
Yeah, absolutely. What's your batting average on your short position since Christmas of 2018? And how does that compare to what it was, for instance, when you first started the firm?
Yeah, well, normally, I mean, we're right on about 2/3 of our positions, sometimes as high as 70%. And I would say that the opposite has happened now. I haven't looked at it recently, but I'd say maybe we've been right on about 1/3 of our positions, and wrong on 2/3 price wise.
You mentioned retail traders. Let's talk about that, because it's not just the Fed putting a floor under asset prices. Retail traders are bidding up everything, especially companies linked to the reopening trade, cruise line operators, restaurants. And I know you've been skeptical on those kinds of companies. Will these companies' business models buckle when the economy does start to normalize and perhaps government stimulus will start to be withdrawn?
Yeah, so we're not short the restaurants right now or cruise line operators, but we are short a number of businesses that I think have changed dramatically, and we're basically beginning to show signs before COVID of weakening trends. COVID accelerated them, and now they've caught a bid because of the reopening trade. But if you look at the businesses and try to value them based on where they were in 2019, pre-COVID, or even 2022, post-vaccine, the valuations make no sense. And that's what's so interesting, because a lot of them have lost a lot of money and have taken on debt or issued equity to get through the pandemic. Their capital structures are much different than they were in 2019. And so in many cases now, if you look at Las Vegas casinos, for example, they're at all-time record valuations relative to their cash flows. And I mean cash flows out a year, not 2020 cash flows.
So you tell a compelling story, but the other side can tell just as compelling a story as well. And we know that we're kind of in a post-truth environment, as you've called it, where my facts are your fake news. And people believe what they want to believe. How much does that get in the way of your short thesis playing out when people will just continue to bid up stocks because maybe the valuations are out of whack, but it can continue to be out of whack for a long time?
It's one of the more odd bullish arguments I hear, in that, yes, people can believe nonsense for a long time. And I said, well, you know, if you're at a poker table, you want to see people with lots of money doing really dumb things with their cards. And you know, if you're playing poker properly, and you want to be in the marketplace, you know, betting against people doing really dumb things with their money. Right now, people are doing really dumb things with their money. It can go on for a while, and you can lose lots of poker hands to people that are doing dumb things with their money. But over time, I would hope that basically, if you're playing properly, you're going to come out ahead.
Are people doing dumb things with their money when it comes to the big mega cap tech stocks?
I think a lot of the big cap tech stocks are pretty good businesses. I mean, if you look at the businesses, if you look at an Apple, or you look at a Google, or even a Facebook, whatever your politics might be on this, and there certainly are risks, but they're very, very high return on capital businesses. Most of them see their profits in cash. I mean, we have no quarrel with that. And so if they trade at 20 times cash flow or something like that in a market with lower interest rates, you know, that certainly might be an appropriate valuation. I don't know, but that's not where, you know, that's not the pool we're swimming in. Mm-hmm. And I think that there's lots of other businesses that aren't great businesses that have gotten inflated valuations.
Would you short some of those big tech names because of possible regulation?
I don't think so. I mean, that's hard to. There are some interesting regulation plays, I think, out there with the new administration, but I don't think big cap tech yet is in there. I could be wrong, but you know, counting on antitrust or something, or a breakup is not something we find interesting in this market.
Now, you are friendly with Joe Biden. I know you've talked with his campaign over the last couple of months. How scared do you think Wall Street should be of how tough he'll be on market regulation, on tech regulation, on taxes.
Well, I mean, I think that first of all, I think that the incoming administration is not going to be anti-market. I do think they probably will be tougher on bad actors in the market. I've dubbed the current environment the golden age of fraud, and I think and I'm hopeful that the incoming administration will toughen the cops on the beat, if you will, in the marketplace. But that should be a good thing. I mean, that should be something that everybody wants.
Do you find that the incidence of fraud candidates is correlated with the multiples of the market, given where we are right now? I mean, does the current environment compare with 2000 or 2007 in terms of opportunity sets?
Oh, it's much greater today. I mean, so I teach a course on the history of financial market fraud, and one of the things we teach, Scarlett, is that the fraud cycle follows the financial cycle with a lag. And the longer a bull market goes, the more people's sense of disbelief erodes, and they begin to believe things that are too good to be true. And I think we're seeing that now more than we've probably ever seen before, in terms of the willingness of markets to buy outright frauds, or where there's evidence of fraud, or even where the evidence of fraud is sort of laid out for you. I hearken back to the Wirecard episode from earlier this year, as a company we were short in Germany. And for a good, better part of 18 months, short sellers and journalists were pointing out a fact pattern that almost inescapably would lead you to believe that there was wholesale fraud going on at this company. And it wasn't until the company itself admitted the fraud in June of this year that the stock collapsed from 100 euros to single digits. And prior to that, almost everything you needed to know was actually out in the public domain on this company. And we're seeing it similarly today in a number of our shorts that we think where there's fraud, particularly some of the Chinese frauds. It is absolutely just remarkable to me as to how many instances of outright fraud are sort of hiding in plain sight. And investors continue to buy the shares of these companies because the companies themselves haven't admitted it yet.
What does it say about the current environment that you have to wait until the company admits fraud before the rest of the market believes it?
I've never seen anything like that. That is new, and that's why I think that's why I've dubbed this the golden age of fraud. In that prior to this, companies that are credibly under a cloud because of evidence would begin to underperform the markets rather dramatically. And now that's not the case. And in many cases, these companies outperform the market until the companies admit the wrongdoing. And that's a really, really new phenomena. And that's one of the reasons why I think the risks in this market are much higher than people think. Because if people are willing to believe criminals who until the criminals themselves admit the crime, you have a very speculative market.
So your specialty is looking for legal fraud, where companies may be following existing accounting rules or regulations, but they're exploiting them with an intention to deceive. However, it's still legitimate. It's still, the lawyers have checked off on it. The accountants have given their okay. How different is that from gaming the system, which is generally something that is seen as a good thing on Wall Street?
The prime example of legal fraud was Enron, right? Where everything they did was legal under the accounting regulations, and they were not prosecuted for accounting fraud. They were prosecuted for lying to their investors. And so it just depends. It depends on the magnitude of what the company is trying to pass off as legal under the accounting or regulatory rules. And is it material to the business? And then if so, when does the market care or does it care? And the poster child of that more recently was Valeant Pharmaceuticals, which went from $10 to $260 back to 10 because it was convincing investors that its pro forma cash earnings per share were $12, and in fact they were losing money. And so, but nothing they did was illegal under the regulations or the accounting rules.
So how much of your current short portfolio do legal frauds, suspected frauds make up right now? And what do you think that will get to in the next couple of years?
I would say it's probably near all-time highs in terms of companies we can point to where there's something wrong with the financial statements, whether legal or not. I would say right now, we looked at it a couple months ago. I think it was about 30% of the portfolio, with 35% of the portfolio, about a third, and that's high. I mean, to have a portfolio 1/3 of frauds is unusually high for us.
What would it normally be?
It normally would be maybe 10%, 15%. Not everything's a fraud. Most shorts are business model issues or business environment issues, and not actual fraud. But now we are actually seeing instances of fraud.
So there are frauds, and then you mentioned there are business balance sheet problems. There are things where something's very hot, like EVs. What category is Tesla in?
Tesla's EV certainly, the market leader in that, and then I think we talked about big cap tech. Having said that, I think that it's really a business model and a valuation issue with Tesla. I mean, there's some things we don't like about their accounting as well, but I mean, this is a company trading at $500 billion market cap. It'll have revenues this year of $30 billion. And despite what everyone says, they're still an automobile company. They make cars. And so they're competing with other companies that make cars. And increasingly, those other companies have EVs as well. And so, Tesla, every bull market has a stock that people pin their hopes and dreams on. Back in the .com era, it was Cisco and Yahoo and a few others, JDSU, and certainly one of those stocks this go around is Tesla, because for some holders it's an EV company, for other holders it's a clean energy company, for other holders it's an autonomous vehicle company, and it's whatever people want to believe that Elon Musk is touting. And that the traditional rules of valuation do not apply to it. I would just point out, as I always do, that for the trailing 12 months, Tesla has not made any money selling cars. The trailing 12 months, whatever profit they've shown, and it's been very, very low, has been from selling tax credits. So for all of this, for all of their market leadership and selling $50,000 on average cars, they're still not making any money doing it.
Have you ever met Elon Musk or talked to him?
I've never met Elon Musk.
Have you ever had a conversation with him or even a tweet firestorm with him?
I don't know about a tweet firestorm, but no, I've never had a conversation with him.
What would you say to him if you do get to meet him?
I'd say job well done so far.
Going back to that idea, people project whatever they want onto the company. You announced your Tesla short back in the fall of 2015. So this has been, what, a 5-year saga. And all your shorts, I remember you're saying, are capped at 5%. Are you still max short on Tesla?
No, we're not max short, only because there's but we are still short. But there's now so many other things to do, including in the EV space, that we found lots of other things that are maybe even crazier than Tesla. But we still do have a position, and it's been painful, clearly. But I will say, for the first 4 years of those 5 years, it was actually not a bad short. It went sideways while the market went up a lot. And so those are the kind of shorts in a bull market that you hope for, right? The market's going up, we're long the market, and our shorts are not going up. But last 12 months, it's been a different animal, as you know.
Yes.
And the stock is up 5 or 6-fold, and we've had to risk manage it like anybody else. But what it has brought forward is lots of other companies now that are trying to ride Tesla's coattails into valuation. I mentioned Nikola, which is one we've been short, and there are others as well that we haven't talked about publicly.
You mentioned risk management. Is there a hard rule for reducing our short exposure when the profit loss hit gets too high?
We don't use stop losses because we use a percent of capital approach for risk management, because if you use stop losses in our world, at least in fundamental shorts, I think we would have been stopped out of every single great short position we ever had. Even Enron went 30% against us at first. So that's a tough rule, but again, calibrating positions on a percent of capital basis for us has worked better.
So Tesla will be added to the S&P 500 in December. Is this a good or bad thing for the overall market?
A lot of people have bought the stock recently because it's going into the S&P 500. I would only point out to them that one of the ways you could have beaten the S&P 500 because it wasn't in the benchmark was to own Tesla over the past couple of years. And then awful lot of funds owned Tesla because it was working and because it was going up and because it wasn't in the S&P 500. And so it's worth pointing that out to people.
Is it a good or bad thing for your hedge fund that Tesla will be included in the S&P 500?
Well, when we do have the ability for long the S&P to overshort those components in the S&P that to neutralize their effect, so we don't become long and short the same stock. But that's a good question.
What is your highest conviction position? Would you say Tesla is one of them? It doesn't sound like it anymore, given that you've reduced your position.
Yeah, no, it's not one of ours anymore, but I mean, we still like it, but there's so much more now that this market has done, and that has given us different opportunities. One, I think, is probably one of my highest conviction ideas is an idea that I think will surprise the viewers. It's a company that nobody's heard of called IBM, and it's a value trap, and we've had a lot of success down through the years in companies that actually have looked cheap but have had really structural fundamental problems. Stories like Exxon and others. And so IBM to us not only is one of those situations, the business is still shrinking, but it's also an accounting story. And I think that's what is so fascinating about IBM, in that the company, we think, is still engaging in basically accounting hijinks. And it's hiding all in plain sight. If you take a look at their numbers, I mean, IBM is supposed to earn $9 pro forma this year. The real number is basically $6. If you look at IBM's operating earnings, very simple for your viewers to do. Just look at IBM's operating earnings plus their intellectual property royalties, subtract out net interest, and tax it at 21% at the statutory corporate rate, and you'll get to about $6 in 2020 in earnings. IBM's going to report $9. Next year, we think the number is going to be $5, Scarlet, and the IBM estimate is close to 12 on my Bloomberg terminal. And in 2022, we think the number is going to be closer to $4, and the Bloomberg estimate is close to 13. And how they're going to turn $4 into 13 over the next 2 years is beyond me, with revenue shrinking. And so IBM increasingly has engaged in lots of games to do this. And the latest one is they're going to do a spinoff and now take a lot of charges that they're going to ask you to add back as part of the adjusted earnings, so that the actual GAAP earnings don't look so bad. But they can only do this for so long. I mean, IBM tried to do this about 5 years ago when they told everyone, and you might remember this, they were always going to earn $20 per share in the out year, and the stock traded around $200. And after about 2015, 2016, they had to reset expectations and really tell the world, well, we're really only earning closer to $10 or $12. And the stock sold off from 200 to 120, which is where it is today. And it's basically been flat since then. But now I think we're looking at the next reset, where they're going to have to tell you that we're not really earning 9, 12, or 13. We're actually earning 6, 5, and 4. And that's going to be the next reset. And I think that that's probably coming over the next couple of years with the stock at $120.
How does commercial real estate fit into your portfolio? Because now that vaccines are within reach, there are a lot of investors who say commercial real estate is starting to look very attractive, value investors taking a closer look.
And what's so interesting about the commercial real estate space is, yes, the narrative, the reopening, it's been swept up in the reopening narrative. And while that certainly will be beneficial for things like hospitality and to a lesser extent retail, it's not really our story, and it wasn't our story going into the vaccine or even the pandemic. Commercial real estate, if we look at urban offices, for example, commercial real estate peaked in 2018, and rents have been declining since 2018 and pre-pandemic, and retail's been under pressure since 2014. In fact, if we go back even further, department store sales peaked in the year 2000. So there have been real pressures pre-COVID that were happening in real estate. But our commercial real estate story is actually a lot different than what you might think. The reason we're negative on commercial real estate is due to interest rates. And that is cap rates, the rate at which people capitalize cash flows in the real estate business, are back at all-time lows, meaning valuations on a dollar of cash flow are at all-time highs. And so that's because of the Fed, and that's because of people's belief that interest rates will never ever go up again. The problem is that when you look at things like office and retail, the cash flows are before capital spending and corporate overhead for the REITs. That's a really important concept, because if you are paying a 5% cap rate for an office building, which is where they're trading today in the public markets, in the REITs. You look at an SL Green or Vornado or companies like that, Brookfield Properties, that's back down to the lows that we saw in 2018, 2019. The reason why some of these REITs are still lower is because the cash flows are down 30% year over year. And so it's fascinating to us that people have sort of disregarded that cash flows were dropping before the pandemic, and are going to continue to stay under pressure because of oversupply of office space or retail space, and yet have brought multiples back to all-time highs, cap rates to all-time lows. And I think that that's the risk in commercial real estate, because at the end of the day, commercial real estate has to compete with all of the private holdings in commercial real estate. This is a $17 trillion market in the US. It's one of the largest asset classes in the US. And increasingly, if you analyze the cash flows in certain subsectors, those cash flows are going to continue to decline even post-pandemic. Whatever your view on work from home is, I think that the need for office space is going to be challenged, for example, for the next handful of years. The need for retail space is going to be challenged as more and more retailers go out of business and landlords have to cut rents. And that's even post-vaccine. And so I think there's a very interesting opportunity in the public markets versus the private markets, in that commercial real estate stocks are now discounting an awful lot of good news.
All right. Jim Chanos, thank you so much.
Scarlet, it's been my pleasure.